This sounds like a simple question, but I think you're about to find out it's not. How do you value a company? The starting point for answering this question is to ask very simply, well, what's a company worth? And you'd think that would have a relatively straightforward answer. The real problem is that actually there is no answer to this question, or rather, there is no single answer to this question. Depending on who you ask, you will get a different answer. Depending on what method you use, you will get a different answer. So valuing a company is a process of trying to narrow down a range of different answers. Our first problem is that markets are not efficient. Whatever the efficient market hypothesis says, it is clear that the information available to the market is imperfect. Some people have more information than others. Some people have more appetite for risk than others. And some people, frankly, are just buyers, and some people are sellers. And there are two different prices right there. You may think that all you have to do is look up the share price of a company and you can find out what it's worth. But market price is not the same as value. In imperfect markets, some companies are undervalued and some are overvalued, whatever the market price happens to be. Value investors, such as Warren Buffett, recognize that markets are imperfect. That's how he's made his money. They compare the financial information in the company's financial statements to the price in the market, and they look to identify companies with certain characteristics which, in their view, are undervalued by the market. So where do we start trying to understand how to value a company? Well, we need to understand that company valuation is a process through which we attempt to estimate the range of economic value a business may have to its owners. Asking why we want to value a business will tell us a lot about its value to us. Fair market value is sought by buyers and sellers to arrive at a price for a transaction. Investment value is what a particular investor is prepared to pay, and he'll have his own strategies and agenda and reasons and his view about risk. Intrinsic value is the in-depth measure of potential economic value in the business, which is derived from a detailed study of the financial records and the future forecasts of the business itself. If we believe that a company has long-term potential, we're going to value it on an going concern basis. We expect it to make profits in the future and therefore to have a future value. We may be more pessimistic and feel that the company's assets should be sold in an orderly way to unlock its value, an orderly disposition. In that case, clearly the assets are going to have to be priced to sell. Or perhaps we're only interested in liquidating the assets as quickly as possible, which would place a much lower value on those assets. The starting point for valuation, then, are the financial statements of the company. Now, we can turn to ratio analysis to understand these numbers in a way that makes comparative valuation with other companies possible. Ratios also tell us about historic trends. The price and earnings ratio enable us to compare the relative market value of the company to other companies. As soon as you reduce it to a ratio, you can make it comparable with the ratios of other companies. It's important, though, to understand the purpose of the three financial statements: the income statement, the balance sheet, and the cash flow. They aim to show a true and fair position of the company, but that has nothing to do with valuation. Accounting principles adjust the numbers. As a result, profits do not equal cash. So we need to make sure that we focus on cash flow and not profit when we're trying to understand valuation, because at the end of the day, that's what investors are going to get. We have already seen that the market can give us an indication of a company's value if that company is publicly traded. We can also look at the financial statements of the firm and consider the value of its assets, ranging from going concern to liquidation. And we can study the cash flow of the business to appraise the value from the historic and future income of the firm. So we can either look at the market value, we can look at the asset value, or we can look at the intrinsic value based on the income. Let's look at these three approaches to valuation in more detail, and we'll start with the income approach. The income approach forecasts the future stream of cash flow or earnings from the business, and using a discount rate, converts the future value to a present value. This is commonly referred to as discounted cash flow, or DCF. The discount rate is derived from the capital asset pricing model, or CAPM. The discount rate is a measure of the risk that the investor is prepared to pay for the investment today in order to benefit from the future cash flows tomorrow. The higher the discount rate, the higher the expectation of risk, and the lower the value. The components of the discount rate are set out in the capital asset pricing model are the risk-free rate, which is equivalent effectively to buying a government bond, the risk premium in addition to the risk-free rate, which effectively accounts for the market risk, and then the beta, or often referred to as the company-specific or asset beta, which reflects the company or asset-specific risk. When valuing the whole firm, the discount rate needs to be adjusted for the balance between debt and equity, as these have different costs of capital and therefore different discount rates. And this is where we turn to the weighted average cost of capital, or WACC. Debt interest, of course, is also tax deductible, which reduces the cost of debt by 1 minus the corporate tax rate. The weighted average cost of capital must be applied to the company net cash flow from total invested capital, and we end up with a valuation of the firm. The asset-based valuation approach starts with the presumption that the value of the firm is the sum of its parts. Asset value in the balance sheet adjusted for depreciation and revalued to fair market value where applicable. But there are fixed assets and there are intangible assets. The intangible asset valuation, of course, is highly subjective. It's more likely to be taken as the difference between fixed assets and market capitalization, so it's derived subsequently. And of course, you have to bear in mind that it's the net asset position you're looking at after taking off the liabilities. Net book values, therefore, may be adjusted if the company is in financial distress. More useful in asset-rich companies such as property investment companies, not so much in technology companies. The market approach assumes that in a free market, the balance of supply and demand will correctly price an asset. This also assumes that information in the market is efficiently distributed and investors act in a logical rather than emotional way. So that you can see there are some flaws in the assumption straight away. Comparable companies valuation is a method where a peer group of comparable companies is used to value either a private or a public company. The average of the peer group valuation ratios, such as the EBITDA multiple or the price earnings multiple, is used to derive a range of values for the company being valued. In the case of a public company, this may help to identify whether the market is undervaluing or overvaluing the company. The precedent transaction approach takes a group of historic M&A transactions and uses them as the valuation benchmark. The deal values are used to derive ratios which are then applied to the company being valued. This approach, of course, is fundamentally historic and backward-looking. It does not take account of any acquisition premiums paid in the deal for the control of the target company. And I can tell you from experience, identifying a suitable peer group and its underlying financial information can be problematic. So these market-based valuation approaches are often used, widely used in fact, by investment bankers for a number of purposes: initial public offerings, M&A advisory work, fairness opinions, restructuring, share buybacks. Multiples and ratios also have a role when deriving the terminal value in a discounted cash flow. So we're going back now to intrinsic valuation. The assumption is that a sale of the business at the end of the cash flow periods, 5 or 10 years normally, and a profit multiple of EBITDA or PE is used to assume that the business has been sold and therefore it puts a value on the business. The alternative approach is to assume the perpetual growth of the firm into the future, which, as you can imagine, is problematic as well. Neither approach is particularly satisfactory, but they are easy to apply. One final word is that you have to beware that terminal value can often be a significant portion of a valuation in a discounted cash flow, so you do need to be very careful how you derive it, whether you're using multiples or the perpetual growth method. So, this is a process and not a destination. Company valuation is clearly a complex topic. You will never arrive at a finite number, and there is always the possibility of further analysis, updates, and of course, negotiation. It's a process, not a journey to a terminal destination. Well, I hope you found this discussion of company valuation helpful. Obviously, it's a very complex topic. It's difficult for me to go into very much detail in a relatively short video. But to learn more, definitely look out for my company valuation course, which offers you over 8 hours of detailed company valuation tuition based on my over 30 years of investment banking experience. So, how do you value a company? Well, you can see after this, it's just as easy as asking, how long is a piece of string?